Wall Street figured out how to turn your death into a tradable asset. I'm not kidding. There are investors right now calculating how much money they'll make when you stop breathing. Introducing death bonds, the only investment backed by your grandma's expiration date. Here's how this morbid financial instrument works. Someone with a terminal illness sells their life insurance policy for cash. A company buys it, pays the premiums, then waits for the person to die to collect the full payout. But Wall Street wasn't satisfied with this simple transaction, so they decided to securitize it. Death bonds bundle hundreds of these life insurance policies together, package them into bonds, and sell them to investors. It's like mortgage-backed securities, except instead of betting on house prices, you're betting on how quickly people die. The math is straightforward. If someone dies earlier than expected, investors make money. If they live longer, returns go down. Your portfolio literally depends on other people's life expectancy. This market emerged from the AIDS crisis in the 1980s, when terminally ill patients needed cash for expensive treatments. They sold their life insurance policies in what's called viatical settlements. It actually served a real purpose back then. But like everything on Wall Street, what started as helping sick people pay medical bills eventually became a tradable asset class, because apparently betting on housing markets and commodities wasn't dark enough. The pitch to investors is pretty compelling, though. Death bonds offer high yields that aren't correlated to stock markets or interest rates. They're backed by the one certainty in life.
The bitch is dead.
The income is tax-free because life insurance payouts aren't taxed, and they even add portfolio diversification. But here's where things get dark. The industry is almost completely unregulated. Basically, anyone can set up shop and start trading death policies. There's little oversight on how these deals are structured or marketed. Critics even compare death bonds to the infamous collateralized debt obligations that fueled the 2008 financial crisis. Both take risky assets, bundle them up, sell them to investors who don't fully understand the risks and hope the math holds up. The returns aren't even that great. Sure, they beat treasury bonds, but they lag behind stocks. So you're taking on a morally sketchy investment for pretty mediocre gains. And here's where it gets truly twisted. Investment firms now actively hunt for sick people to buy policies from. Entire companies are built on tracking down the terminally ill, offering them quick cash, and then turning their deaths into Wall Street products. It's capitalism at its most ruthless, profiting off desperation, medical debt, and mortality itself. The market for death bonds peaked around $50 billion before the 2008 crisis. It's smaller today, but it never went away. Somewhere right now, a hedge fund manager is literally calculating whether your grandmother's cancer diagnosis makes her a good investment. This isn't just about making money from tragedy. It's about how financial markets will commoditize literally anything if there's profit involved. We've gone from trading corn and oil to trading human mortality. The fact that this market exists at all says something pretty dark about our economic system. When Wall Street runs out of things to securitize, apparently the next logical step is packaging people's deaths. This has been your reminder that somewhere in the financial system, someone is betting against your life expectancy. I am your host, Mr. X Banker. Thanks for watching, and I'll see you in the next one.